Hello everybody, welcome to Intermediate Accounting. This is the Spiceland book. In this chapter we're going to finish our discussion on inventory measurement by talking about how inventories are measured at the end of the period. As you would expect, companies hope to sell their inventory for more than its cost, but it doesn't always happen that way. Sometimes circumstances arise after or subsequent to the purchase or production of inventory that indicate that the company will have to sell its inventory for less than its cost. This might happen because of inventory damage, physical deterioration, obsolescence, changes in price levels, or any situation that lessens the demand for the inventory. Generally accepted accounting principles require that companies evaluate their unsold inventory at the end of each reporting period. So, when the expected benefit of unsold inventory is estimated to have fallen below its costs, companies have to depart from the cost basis of reporting ending inventory, and an adjusting entry is needed to reduce the reported amount of inventory and then to reduce net income for the period. Now, the end of period adjusting entry is known as an inventory write-down. Two measurement approaches for recording an inventory write-down are shown here. The approach chosen by a company depends on which inventory costing method the company uses. For companies that used a cost method other than LIFO or the retail inventory method, we report inventory at the lower of cost or net realizable value. For companies that use LIFO or the retail inventory method, which we'll talk about later, we report inventory at the lower of cost or market. So for both measurement approaches, the financial statement effects of an inventory write-down are the same. Reduce reported inventory and we reduce net income. Both approaches have the same conceptual purpose of reporting inventory conservatively at the lower of two amounts. The difference between these two approaches is the measurement of the amount of the inventory write-down. So companies that use FIFO, average cost, or any other method besides LIFO or the retail inventory method, report inventory using the lower of cost or net realizable value approach. So to do this, a company compares the inventory's cost to the inventory's net realizable value. The NRV is the estimated selling price of the inventory in the ordinary course of business, reduced by reasonable, predictable costs of completion, disposal, and transportation, like sales commissions and shipping costs. Another way to think about NRV is that it's the net amount a company expects to realize or collect in cash from the sale of the inventory. After comparing cost and net realizable value, a company reports inventory at the lower of these two amounts. If net realizable value is lower than cost, then we need an adjusting entry to reduce inventory from its already recorded purchase cost to the lower NRV. NRV then becomes the new carrying value of inventory that gets reported in the balance sheet. If cost is lower than NRV, then we don't have to do any adjustments. Inventory already is recorded at cost at the time it was purchased, and this cost is lower than total NRV at the end of the period. The lower cost net realizable value approach avoids reporting inventory at an amount greater than the cash it can provide to the company. Reporting inventories this way causes income to be reduced in the period the value of inventory declines below its cost, rather than in the period in which the goods ultimately are sold. So, for financial reporting purposes, LCNRV can be applied to individual inventory items, to major categories of inventory, or to the entire inventory. So the example here demonstrates the LCNRV approach with each of the three possible applications. The Collins Company has 5 inventory items on hand at the end of the year. The year-end cost determining by applying the FIFO cost method and the net realizable value current selling price less cost of completion, disposal, and transportation for each of these items are presented. Now, items A and B are a collection of similar items, and items C and D, along with E, are another collection of similar items. Each collection can be considered a category of inventory. If we first consider LCNRV by individual items, we see that cost is lower than net realizable value for items A and E. These inventory items were initially recorded at cost at the time of purchase, so under the LCNRV approach, they're currently recorded at their proper amounts. No adjustment is needed. But for items B, C, and D, we see that NRV is below cost. So we need to adjust the carrying amount of these items downward and report them at net realizable value in the balance sheet. After determining the lower of cost, or NRV, for each individual item, the total amount to report for inventory is $395,000. Now let's see what happens if we apply the LCNRV approach by inventory category. The first category of inventory, items A and B, has a combined cost of $150,000 and a combined NRV of $175,000. So we report this second inventory group at its cost of $150,000. For the second category, items C, D, and E, the combined NRV of $256,000 is lower than the combined cost of $265,000. So we report the second inventory group at its NRV of $256,000. We report inventory at $406,000, which is the $150 plus the $256,000. Now, finally, we apply the LCNRV approach by total inventory. We see that inventory's total cost of $415,000 is lower than its total NRV of $431,000. So we will report inventory at $415,000. So as shown in this slide, applying the LCNRV rule to groups of inventory items will cause a higher inventory valuation than if applied on an item-by-item basis. The reasons that group application permits increases in the net realizable value of some items to offset decreases in others. Each approach is acceptable but should be applied consistently from one period to the next. When NRV is below cost, companies are required to write down inventory to the lower net realizable value. This is accomplished in one of two ways depending on the nature of the decline in inventory value. These write-downs usually are included in cost of goods sold because they're a natural consequence of holding inventory and therefore part of the inventory's cost. However, when a write-down is substantial and unusual, a write-down should be recorded in a loss account instead. That loss must be expressly disclosed in the financial statements. This can be accomplished with a disclosure note, alone, or by also reporting the loss in a separate line of the income statement, usually among operating expenses. Now, referring back to the example on the previous slide, assume that we report inventory using the LCNRV approach by individual items. The recorded cost of inventory, the $415,000, needs to be written down to its net realizable value of $395 at the end of the period. So the amount of the reduction is $20,000. The period end adjusting entry would be one of the following, depending on whether the inventory write-down is usual, which would then go into cost of goods sold, or if it's unusual, we're going to show it as a loss on the write-down of inventory. Regardless of which entry we use to report the write-down, the reduced inventory amount becomes the new cost basis for subsequent reporting. If the inventory value later increases prior to its sale, we do not write it back up. Let's take a look at a concept question here. The following information pertains to one item of inventory of Forge Company. We have a cost of $270, a replacement cost of $225, the selling price of $292, and our cost to sell of $52. So if we apply the lower of cost or net realizable value, this item should be valued at $240. So it's going to be the $292 selling price minus the cost to sell. That is lower than our cost of $270. You've learned that in the United States, some companies report inventory at the lower of cost or net realizable value. This is the same approach used under IFRS, but there are some differences between GAAP and IFRS in applying the lower of cost or net realizable value. First, IAS number 2 specifies that if circumstances indicate that an inventory write-down is no longer appropriate, it must be reversed, while in GAAP we are not permitted to have reversals. Second, under GAAP, the lower of cost or net realizable value can be applied to individual items, to inventory categories, or the entire inventory. But under the international standard, the assessment usually is applied to individual items, although using inventory categories can be allowed in certain situations. Let's check out another question for us. Which of the following statements is not true concerning using lower of cost or net realizable value for GAAP and IFRS purposes? A. Both U.S. GAAP and IFRS allows for reversals of inventory write-downs if circumstances indicate the write-down is no longer appropriate. Now we know that's not true because GAAP does not allow reversals. U.S. GAAP allows the LCNRV rule to be applied to individual items, to categories, or to entire inventory. IFRS requires LCNRV to be applied to individual items except in certain circumstances, and then IFRS require disclosures of inventory valuation methods in the notes. So all of these are true except for A. While IFRS allows reversals, GAAP does not. Companies that use LIFO or the retail inventory method reporting use the lower of cost or market approach, which we call LCM. You might interpret the term market to mean the amount that could be realized if the inventory were sold. This would be similar to the concept of net realizable value. However, market is defined different. Market's the inventory's current replacement cost by purchase or reproduction, except that market should not be greater than the net realizable value, which we call the ceiling on the market. And market should not be less than net realizable value reduced by an allowance for an approximately normal profit range, which we would then call the floor. So in effect, we have a ceiling and a floor between which market or replacement cost must fall. If replacement cost is between the ceiling and the floor, it represents market. If replacement cost is above the ceiling or below the floor, then the ceiling or the floor becomes market. The designated market amount is compared with cost, and the lower of the two is then used to value inventory. So here's an example. We first need to calculate the ceiling, and then we need to calculate the floor. Next, we need to calculate LCM. Note the market amount for each inventory item is simply the middle value among replacement cost, NRV the ceiling, NRV minus NPM, the floor. When replacement cost is either below the floor, item A, we select the floor as the market. When it's above the ceiling, like items B and C, we select the ceiling as the market. Or if it's between the ceiling and the floor, like items C and E, then we're going to select replacement cost as the market. We then compare each item's designated market amount to its cost and choose the lower of the two. After doing this, ending inventory under LCM is $387,000, which means that the recorded cost of $415,000 must be reduced by $28,000. We record that adjustment to cost of goods sold if the decrease to market is considered normal for this company. Otherwise, we record the reduction as a loss. The example we just saw calculates LCM on an individual item basis. The LCM method also can be applied to major categories of inventory or to the entire inventory, just like we saw under the LCNRV approach. Inventory using the LCM approach applied by category would be reported as $397,000. If we calculate LCM by total inventory, then the amount to report for ending inventory would be $402,000. So let's take a look at our next concept question. The following information pertains to one inventory item of inventory for forge. Applying the lower of cost or market rule, this item should be valued at $225. So the replacement cost of $225 is between the ceiling, which is the sales price minus the cost of goods sold, and then the floor, which is the $240, the net amount, minus the normal profit margin, or $209. Since this market is replacement cost is $225, then market of $225 is lower than the cost of $270. Now let's take a look at exercise 9.1. Merrill Company has 3 products in its ending inventory. Specific per unit data for each of the products is as follows. Product 1, cost is 40, selling price is 80, cost to sell is 12. Product 2, cost is 180, selling price is 240, cost to sell is 80. Product 3, cost is 100, selling price is 140, and the cost to sell is 20. So what unit value should Merrill use for each of its products when applying the lower of cost and net realizable value to ending inventory? Well, as you see here, the net realizable value is the selling price minus the cost to sell. So as you see, the net realizable value in 1, the selling price minus the cost to sell, is 68. In product 2, I'm sorry the screen is so goofy, it's going to be 160, the selling price minus the cost to sell of 160. And then in unit 3, 120. Then the inventory value, product 1 is 40, product 2 is 180, and product 3 is 100. For some companies or in certain situations, it becomes difficult or even impossible to physically count each unit of inventory. Consider a large retail company that has locations over the entire nation and sells many different items. Trying to track the cost of each item would be nearly impossible. So in these situations, companies have developed methods for estimating inventory. The gross profit method, also known as the gross margin method, is useful in situations where estimates of inventory are desirable. The technique is valuable in a variety of situations, such as determining the cost of inventory that has been lost, destroyed, or stolen, estimating inventory and cost of goods sold for interim reports, avoiding the expense of a physical inventory count, in auditors' testing of the overall reasonableness of inventory amounts reported by clients, and in budgeting and forecasting. Let's compare the gross profit method with the way inventory and cost of goods sold are normally determined. Using a periodic inventory system, ending inventory is known from a physical count, and cost of goods sold is derived as follows. Beginning inventory from the accounting records plus net purchases equal our goods available for sale, less our ending inventory from a physical count gives us our cost of goods sold. But when we're using the gross profit method, the ending inventory is not known. Instead, the amount of sales is known from which we can estimate the cost of goods sold, and ending inventory is the amount calculated. So the beginning inventory from the accounting records plus the net purchases equal our cost goods available for sale, less our cost of goods that are estimated would give us our ending inventory that is also estimated. So a first step in estimating inventory is to estimate cost of goods. This estimate relies on the historical relationship among net sales, cost of goods, net sales, cost of goods sold, and gross profit. Gross profit is simply net sales minus cost of goods sold. So if we know what net sales are, and if we know what percentage of net sales the gross profit's going to be, we can fairly accurately estimate cost of goods sold. Companies often sell products that have similar gross profit ratios. As a result, accounting records usually provide the information necessary to estimate the cost of ending inventory, even when a physical count is highly impractical. Suppose a company began the year with inventory of $600,000, and on March 17th, a warehouse fire destroyed the entire inventory. Company records indicate net purchases of $1,500,000 and net sales of $2 million prior to the fire. The gross profit ratio in each of the previous 3 years has been very close to 40%. Here we see how the company can estimate the cost of the inventory destroyed for its insurance claim. The gross profit method provides only an estimate. The key to obtaining good estimates is the reliability of the gross profit ratio. The ratio usually is estimated from relationships between sales and cost of goods sold. However, the current relationship may differ from the past. In that case, all available information should be used to make necessary adjustments. So, for example, if the company may have made changes in the market percentage of some of its products, and very often different products have different markups. So in these situations, a blanket ratio wouldn't be applied across the board. The accuracy of the estimate can be improved by grouping inventories into pools of products that have similar gross profit relationships, rather than using one gross profit ratio for the entire inventory. The company's cost flow assumption should be implicitly considered when estimating the gross profit ratio. Like if LIFO is used and the relationship between cost and selling price has changed for recent acquisitions, this would suggest a ratio different from one where the average cost method was used. Another difficulty with the gross profit method is that it does not explicitly consider possible theft or spoilage of inventory. The method assumes that if the inventory was not sold, then it must be on hand at the end of the period. Suspected theft or spoilage would require an adjustment to estimates obtained using this gross profit method. The records of Oregon Timbers revealed the following information related to inventory destroyed in a fire. The beginning inventory is $900,000, purchases to date of fire $480,000, Net sales to date of fire, $1,350,000, and the gross profit ratio of 30%. The estimated amount of inventory destroyed by the fire is $975,000, $30,000, $435,000, or all of these answers are incorrect. So the way in which we're going to calculate this is we're going to start with our beginning inventory and add our purchases. We're going to subtract out what we estimate the cost of sales to be. Now we'll estimate that by showing the sales to date times 70%. Since 30% is the gross profit ratio, then that means 70% would be the cost of products sold. So if we take the 900 plus the 480 minus our 945 cost of goods estimated to be sold, we would end up with a difference of $435,000. So let's look at exercise 9.8. On August 1st, 29th of year 1, a flood destroyed the entire merchandise inventory on hand in a warehouse owned by the Flash Sports Company. The following information is available from the records for the company's periodic inventory system. Our job is to estimate the cost of inventory destroyed in the flood using the gross profit method. So again, we're going to start with our beginning inventory. We'll add our purchases. That gives us our cost available for sale. If our sales were $150 and we had a gross profit of $25, that means 75% of that would be cost of goods, estimated cost of goods. Therefore, our $125 minus our estimated cost of goods sold mean our cost of inventory that would be destroyed, estimated, would be $12,500. Let's now look at exercise 9.9. On November 21st of year 1, a fire at Mindo Company's warehouse caused severe damage to its entire inventory of product techs. Mindo estimates that all usable damaged goods can be sold for $13,440. The following information was available from the records of Mindo's periodic inventory system. The gross profit ratio is 31% of net sales. So our job, calculate the estimated loss on the inventory from the fire. So we've got our sales of $246,400, and if our profit is 31%, then that means our cost of goods sold needs to be 69%, or $170,016 estimated. The difference would be the gross profit. So our beginning inventory of $112 plus our net purchases of $156 gives us a total of $268. Minus our $170,016 shows that the ending inventory damaged is $98,784. So our ending inventory of $98,784, the usable goods of $13,440 shows the loss from the fire would be $85,344. As the name implies, the method is used by many retail companies such as Target, Walmart, Sears Holding Company, Penny's, and Macy's. Certain retailers like auto dealers and jewelry stores, whose inventory consists of few high-priced items, can economically use the specific identification method. High-volume retailers selling many different items at low unit prices find the retail inventory method ideal. Its principal benefit is that a physical count of inventory is not required to estimate ending inventory and cost of goods sold. In its simplest form, the retail inventory method first estimates the amount of ending inventory at retail by subtracting sales from goods available for sale. Retail amounts refer to current selling prices. Ending inventory at retail is then multiplied by the current cost to retail percentage to estimate ending inventory at cost. The cost to retail percentage is found by dividing goods available for sale at cost by goods available for sale at current selling prices. Here we see an example of the retail inventory method. Home improvement stores uses a periodic inventory system and the retail inventory method to estimate ending inventory and cost of goods sold. The data shown here are available from the company's records for the month of June. Home improvement stores first estimates ending inventory at retail, $160,000, by subtracting net sales from goods available for sale at retail. Ending inventory at retail is multiplied by the cost to retail percentage of 62%, which is found by dividing goods available for sale at cost by goods available for sale at current selling price. This multiplication leads to an estimate of ending inventory of $99,200. This amount is subtracted from the cost of goods available for sale to estimate cost of goods sold of $248,000. After the initial markup of inventory, but before it's been sold, companies sometimes increase the selling price further, an additional markup, or reduce the selling price, which is a markdown. For applying the retail inventory method, we need to track the movement in the selling price until it is sold. The following items are associated with changing retail prices of merchandise inventory: initial markup, original cost of markup from cost to selling price; additional markup, increase in selling price subsequent to initial markup; markup cancellation, elimination of an additional markup; markdown, the reduction in selling price below the original selling price; or markdown cancellation, the elimination of a markdown. So to illustrate here, assume that a product purchased for $6 is initially listed with a selling price of $10, which is a $4 initial markup. If the selling price is subsequently increased to $12, the additional markup is $2. If the selling price is then subsequently decreased to $10.50, the markup cancellation is $1.50. A markup cancellation reduces an additional markup, but not below the original selling price. We refer to the net effect of the additional changes, the $2 minus the $1.50 equals 50 cents, as the net markup. It shows you here in this slide. Now let's say the selling price of the product purchased for $6 and initially marked up for $10 is reduced to $7. The markdown is $3. If the selling price is later increased to $8, the markdown cancellation is $1. The net effect of the change, the $3 minus the $1, is $2, which is the net markdown. The bottom illustration here depicts this possibility. Now, when applying the retail inventory method, net markups and net markdowns must be included in the determination of ending inventory at retail. So with the help of this slide, we're going to see how the retail inventory method can be used to approximate different cost flow assumptions. Home improvement stores uses a periodic inventory system and the retail inventory method to estimate ending inventory and cost of goods sold. So you see here the data shown for the month of July. Recall that the average cost method assumes that cost of goods sold and ending inventory each consist of a mixture of all the goods available for sale. So when we use the retail method to approximate average cost, the cost to retail percentage should be based on the weighted averages of the costs and retail amounts for all goods available for sale. This is achieved by calculating the cost to retail percentage by dividing the total cost of goods available for sale by total goods available for sale at retail. When this average percentage is applied to ending inventory at retail, we get an estimate of ending inventory at average cost. We demonstrate the retail inventory method approximating average costs for July here. Notice that both markups and markdowns are included in the determination of goods available for sale at retail. By adding beginning inventory net purchases and net markups and deducting the net markdowns, we get goods available for sale at cost of $404,480 and goods available for sale at retail of $632,000. The cost to retail percentage is calculated by dividing the total cost of goods available for sale of $404,480 by total goods available for sale at retail of $632,000. This gives us a cost to retail percentage of 64%. By deducting net sales of $434,000 from goods available for sale at retail, $632,000, we arrive at an estimated ending inventory at retail of $198,000. Next, the estimated ending inventory at cost is calculated by multiplying $198,000 of estimated ending inventory at retail by the cost to retail percentage of 64%. This gives us an estimated ending inventory cost of $126,720. Finally, the estimated cost of goods sold is calculated as goods available for sale at cost, $404,480, less estimated ending inventory at cost, $126,720. This gives us an estimated cost of goods sold of $277,760. Let's look at another concept question. The Bowden Company uses the retail inventory method. The following information is available for the year. So as you see here, our inventory, $780, retail, $1,300,000, net purchases for the year, $2,804,000, retail is $3,670,000, net markups, $150, net markdowns, $90, net sales, $3,690,000. Applying the average cost retail inventory method, Bowden's inventory at the end of the year is estimated at $954,784, B, $790,318, C, $938,000, or D, $810,700. So, the way we'll figure this out is we start with our ending inventory at retail, the $1,340,000. So we get that from our beginning inventory at retail plus our purchases plus our markups minus our markdowns minus our net sales. So our cost to retail ratio we find is 71.2525%. So if we take at cost the $780 plus the purchases at cost of $2,804,000, divide that by the amounts at retail, the $1,003,000 plus the $3,670,000 plus markups and markdowns, we end up with an ending inventory at cost of the $1,340,000 times that markup cost to retail ratio, 71.2525%, or the $954,784, 1,600. Recall from our discussion earlier in the chapter that companies using the retail inventory method report inventory in the balance sheet at the lower of cost or market. Fortunately, we can apply the retail inventory method in such a way that the lower of average cost or market is approximated. This method is often referred to as the conventional retail method. We apply the method by excluding markdowns from the calculation of a cost to retail percentage. Markdowns still are subtracted in the retail column, but only after the percentage is calculated. To approximate lower of average cost or market, the retail method is modified as we see here. Note that by not subtracting net markdowns from the denominator, the cost to retail percentage is lower than it was previously, 63.2% versus the 64%. This always will be the case when markdowns exist. So as a result, the cost approximation of ending inventory always will be less when markdowns exist. To understand why this lower amount approximates the lower of average cost or market, we need to realize that markdowns usually occur when obsolescence, spoilage, overstocking, price declines, or competition has lessened the utility of the merchandise. To recognize this decline in utility in the period it occurs, we exclude net markdowns from the calculation of the cost to retail percentage. It should be emphasized this approach provides only an approximation of what ending inventory might be as opposed to applying the lower of cost or market rule in the more exact way we talked about earlier. Notice also that the ending inventory at retail is the same using both approaches, 198,000. This will be the case regardless of the cost flow method used, because in all approaches, the amount reflects the ending inventory at current retail prices. So the last in first out method assumes that units sold are those most recently acquired. When there's a net increase in inventory quantity during a period, the use of LIFO results in ending inventory that includes the beginning inventory as well as one or more additional layers added during the period. When there's a net decrease in inventory quantity, LIFO layers are liquidated. In applying LIFO to the retail method in the simplest way, we assume that the retail prices of goods remain stable during the period. This assumption, which is relaxed later in the chapter, allows us to look at the beginning and ending inventories in dollars to determine if inventory quantity has increased or has decreased. So we'll use the numbers from our previous example to look at using the retail method to approximate LIFO so we can compare the results with those of the conventional retail method. Recall that beginning inventory at retail is 160,000 and ending inventory at retail is 198,000. If we assume stable retail prices, inventory quantity must have increased during the year. This means ending inventory includes the beginning inventory layer of 160,000, 99,200 at cost, as well as some additional merchandise purchased during the year. To estimate total ending inventory at LIFO cost, we also need to determine the inventory layer added during the period. When using the LIFO retail method, we assume no more than one inventory layer is added per period if inventory increases. Each layer will carry its own cost to retail percentage. So here's how home improvement stores would estimate total ending inventory and cost of goods sold for the period using the LIFO retail method. The beginning inventory layer carries a cost to retail percentage of 62%, which is 99,200 divided by 160,000. The layer of inventory added during the period is 38,000 at retail, which is determined by subtracting beginning inventory at retail from ending inventory at retail. This layer would be converted to cost by multiplying it by its own cost to retail percentage, reflecting the current period's ratio of cost to retail amounts, in this case 64.68%. Now the next period's August beginning inventory will include the two distinct layers of June and July, each of which carries its own unique cost to retail percentage. Note in the slide that both net markups and net markdowns are included in the calculation of the current period's cost to retail percentage. To focus on the key elements of the retail method, we've so far ignored some of the details of the retail process. Fundamental elements such as returns and allowances, discounts, freight, spoilage, and shortages can complicate this method. So this is a recap of special elements in the application of the retail method. Freight in is added to the cost column before calculating the cost to retail percentage. Purchase returns are deducted in both the cost and retail columns. If the gross method is used to record purchases, then purchase discounts taken should be deducted in the total cost column. Abnormal shortages and spoilages should be deducted in both the cost and retail columns. After calculating the cost to retail percentage, all normal shortages due to spoilage, breakage, and theft should be deducted in the retail column, and employee discounts should be added to net sales. So let's take a look at this question. The Bowden Company uses the retail inventory method. The following information is available for the year. Inventory, the beginning of the year, $780. The retail, $1,300,000. Net purchases, $2,804,000, and retail, $3,670,000. Net markups, $150,000. Net markdowns, $90,000, and net sales, $3,690,000. So applying the conventional retail inventory method, Bowden's inventory at the end of the year is estimated at, it will be $938,000. So we're going to take the ending inventory at retail, the $1,340,000, which we would derive from the $1,300,000 plus the $3,670,000 plus the $150,000 markups minus the markdowns minus the net sales. We get a cost to retail ratio of 70%. So the ending inventory at retail is the $1,340,000. The cost to retail percent is going to be the $780,000 plus the $2,804,000 purchases. Divide that by the retail beginning inventory plus purchases plus the markups. Therefore, our inventory at cost is the $1,340,000 times the 70%, or $938,000. So if we look at exercise 915, Hybrid Company owns a chain of hardware stores throughout the state. The company uses a periodic inventory system and the retail inventory method to estimate ending inventory and cost of goods sold. The following data is here. We've got our beginning inventory at cost and retail and our purchases at cost and retail. We have our net markups and our net markdowns along with our net sales. So estimate the LIFO cost of ending inventory and cost of goods sold for the 3 months ending March 31st, year 1. So our beginning inventory, cost and retail, along with our purchases, we add the markups, we subtract the markdowns, and then we show the goods available for sale, excluding our beginning inventory of $1,027,200 retail, and then cost of goods available at cost $729,312. Now, if we include our beginning inventory, we're at cost of $921,312, retail $1,363,200. So beginning inventory cost to retail percent, we take the 192 divided by 336 gives us 57.1429%. If we take our cost to retail percent during the year, we're at 71%. So we take less our net sales of 960, shows that estimated ending inventory at retail is 4032. In order to then figure out the breakdown here, we show on the beginning inventory at 57.1429% times our retail price of the beginning inventory, and we'll do that also during the purchases during the year because that breakdown was at 71%. So our cost then for the beginning inventory is at 192. The current period's layer during the year of 47,712 shows the cost of 239,712. Therefore, the estimated cost of goods sold will be $681,600, which would be the goods available for sale minus the 239,712. Let's look at exercise 914. Diamond Corporation uses the retail method to value its inventory. The following information is available. Determine the December 31st, year 1 inventory that approximates average cost, lower of cost, and net realizable value. So, our beginning inventory cost is 200, retail 320, plus our purchases, cost, and retail. We'll add in our freight, add our markups to retail to give us total retail of 1,218,000. Subtract our markdowns to give us our goods available for sale. Our sales, net sales of 900,000 would give us an estimated ending inventory at retail of 312,000. Our cost to retail percent will be our cost of goods available for sale, the 1,212,000, divided by, cost of goods available for sale is the 912, divided by the retail of goods available for sale, excluding markdowns, is the 1,212,000. 1,218 because we keep out the markdowns. So we have the cost to retail percent of 75%. 75% of the 312,000 would be $234,000. Next, exercise 916. 916. DeMont Variety Store uses the retail inventory method to estimate ending inventory and cost of goods sold. Data for 2016 are as follows. We've got beginning inventory, cost of $13,000, retail of $21,667. Purchases of $1,026, retail of $165,000. Freight in $3,980, purchase returns $3,700. On retail $6,475. We have our net markups, our net markdowns, and normal spoilage, along with retail net sales. Estimate the ending inventory and cost of goods sold for 2016 applying the conventional retail method. So we're going to start with our beginning inventory add our purchases and our freight in, minus our purchase returns, and then from there our net markups. Our net markdowns give us then our goods available for sale. Spoiled goods are not available for sale. They get subtracted after the goods available for sale total, which then gives us our net sales. Our ending inventory, $27,692. The goods available for sale, less our spoilage, and our net sales. Now, we've got cost of goods available for sale. Divide that by our retail of goods available, less excluding the markdowns. So that's the $115,880. Divide that by the $186,092. It's going to be cost of goods available without the markdowns. Gives us our 62%. Take our ending inventory at retail by that 62%. Then we can plug in our net sales at cost. Now let's look at exercise 917. 917. Augustine Department Store uses the retail inventory method to estimate ending inventory for its monthly financial statement. The following data pertain to one of its largest departments for the month of March 2016. Sales are recorded net of employee discounts. Compute estimated ending inventory and cost of goods sold for March, applying the conventional retail method. Compute the cost to retail percentage using the average cost method. So here we have the information here. We'll begin by computing the estimated ending inventory and cost of goods sold for March using the conventional retail method. We begin with our beginning inventory, add our purchases, plus our freight in, minus our returns, and we add our markups to come up with our costs available for sale. Now, our net markdowns we subtract out, but we don't always use this figure in determining our gross markup profit percent. With our normal breakage, remember those aren't goods available for sale because they aren't worth being able to be sold. Our net sales, $269,468. Our ending inventory is $150,851. So our goods available for sale is the $279,187. Divide that by our $429,519. We don't include the markdowns there. To give us 65%, our $150,851 times the 65% gives us an ending inventory of $98,053. We can compute our net sales, $181,134. Let's go back here. So, cost of goods available for sale divided by our retail of goods available for sale. The cost to retail percentage using the average cost method, 65.48%.